Good afternoon, everybody. I'm just going to wait just a minute here. I see a number of attendees that are logging on to the webinar call. So we'll just give everyone a little bit of time to join in. Great, we've got a popular webinar this afternoon. Great. Okay, so I think we've got many of our attendees now in. So without any further ado, I'm just going to welcome everybody to another UDI Okanagan webinar. And we're obviously appreciative of everyone taking the time to join us this afternoon. Today's webinar is entitled Delta Dawns on Outlook with Doug Porter. And I've recently learned that Delta Dawns is the name of a Tanya Tucker song. And so I've learned one thing today, and I know I'm going to learn a heck of a lot more through Doug's presentation and our Q&A. My name is Luke Turi. I am the current chair of UDI Okanagan. And I certainly hope everyone's settled into the first few weeks of fall, getting into some of those more normal routines. We're really excited to have our first regular fall event today, regular in the virtual context. Of course, we're looking forward to having in-person sessions as soon as we can. I mean, I do also want to mention before we get into to our webinar today, that as always, there's lots of work that's going on behind the scenes within our board, our committee members, certainly that Jennifer, our executive director, is doing as well. To help support our industry. And in particular, I did want to recognize all of the ongoing work that UDI is undertaking, providing feedback into the City of Kelowna official community plan process. It's recently gone to council and it will be at a public hearing later on in October. And we're going to continue as an organization to advocate for healthy growth of our cities, and in particular to find solutions that are mutually beneficial to bring much needed additional housing supply into the Okanagan. Also, before we get into today's session, like always, I want to remind you that we will have a Q&A session with Doug after the formal presentation. So you can use the chat function in Zoom to ask any questions that you have, and hopefully we'll be able to get through a number of them. And I want to thank today's speaker, of course, Doug Porter, and I'll introduce him here and then hand things over. And Douglas Porter is the Chief Economist and Managing Director of BMO. He has over 30 years of experience analyzing global economies and financial markets. As Chief Economist at BMO Financial Group, he oversees the macroeconomic and financial market forecasts and co-authors the firm's weekly flagship publication, Focus. Mr. Porter manages the team that has won many awards and was named by Bloomberg as top Canadian forecaster. As a respected commentator on economic and financial trends, he is regularly quoted in the national press and often interviewed on radio and on television. Doug has graciously done this a number of times for UDI Okanagan as well as other UDI chapters. We're always very grateful to have him. So, Doug, welcome. I'll hand it over to you, and I look forward to our Q&A in a little bit.
Okay, thank you very much, Luke, and good afternoon, everyone. I join you today, unfortunately virtually, but I join you today from just outside of Toronto. Pleasant day, I must say. So what I plan on doing over the next 30 minutes or so is just basically laying out where we see the global, Canadian, BC economies going. Then I'm going to talk a little bit about financial markets, what it might mean for things like interest rates and the dollar, and I will talk a little bit about inflation, and of course I'll also bring in our overall view on the housing market. So with that, I would now like to share my screen and go through a small slide presentation to basically go along with my comments. So first of all, since it's fresh, I thought I'd start off a little bit with the recent election. A few points here. First of all, I'm an armchair political analyst. I'm not an expert on this front by any means, but it's simply striking how similar the result is, almost down to the decimal point. in terms of the popular vote that we had versus 2019. Almost no seat change whatsoever. The one thing I would say is, because let's face it, this was not a popular election, I think the bar for calling another vote will be very high. So I suspect that even though we have a minority government, this minority government may have legs. I suspect that will last a fairly long time, because it's going to be on whichever party basically forces or prompts the next election. And as I said, I don't think the next election is going to be very popular either. So I suspect that we may well last a while. Now, even though we've got political status quo, I would argue that it's not necessarily completely status quo on the economic front as a result of the election. One thing that really did unfold during the campaign is every party promised a lot in terms of new spending. And just to look at, say, the Liberal platform, for instance, when we stack it up versus what the PBO, or the Parliamentary Budget Office, was estimating for the budget deficit, you can see that the Liberal Party's platform then adds on an extra layer to the deficit, because they unveiled the spending program of $78 billion over the next 5 years, on top of what was already a fairly generous spending budget earlier this year. Now, of course, that's just their proposal. To get through Parliament, they're going to have to win the support of another party. All signs suggest that's probably going to be the NDP, who have even more aggressive spending proposals. So I suspect that at the end of the day, we're going to see a lot more spending. I think that's really the end result of this year's election campaign, above and beyond the 600 million that was spent directly on the election. That's completely different. And of course, there were also some revenue measures that were mooted about. Now, the NDP, for one, had a long laundry list of potential revenue measures. The Liberals had a few, nothing certainly nearly as aggressive as what the NDP was suggesting. I do think that ultimately, to get the NDP support, they'll probably have to agree to at least one of those revenue measures, and certainly some of the spending measures as well. In terms of the debt numbers, I was often asked in the last year and a half, how are we going to pay for all of this? Well, effectively, the way we're going to pay for it is this big step up you see in the debt to GDP on the right-hand side. Hopefully, this is a one-time affair where, after years and years of stability, where Ottawa's debt to GDP was about 30%, it's now stepped up to around 50% of GDP. Even under this forecast for the budget deficit, it does look like the debt ratio would stabilize. But I have to say, the risks to all these numbers are probably a little bit to the high side, because I don't think that's the final word on spending. And this GDP forecast is relatively optimistic. So we'll see whether they can actually hold the line on that front. And again, I think that the bottom line was we are likely looking at a very generous fiscal policy in the years ahead, for better or worse. So that's the very big picture in terms of the election outcome. Let's now turn to everybody's least favorite topic, and that's COVID. The title says upswing in cases. It really does depend on where you're looking at. In fact, in recent weeks, this chart on the left is the rolling average of new cases. It's based on per capita terms. So U.S. is comparable to the big 5 European countries, which are comparable to Canada, and you can see the differences between the three. In recent weeks, the U.S. numbers actually have started to moderate. They're still well above anything we see in Europe or Canada. Europe, you can see it's doing a slow drift down, but it really does depend on the country. The number of new cases is still actually quite high in the UK, and it's flat to down in most other economies. Canada, again, it depends on which province we're looking at. Here in my province, Ontario, we actually are drifting down in recent weeks. Of course, we're still going the other way in places like Alberta and Saskatchewan. So it's quite a different picture depending on where you are in the country. And this is all happening despite relatively high vaccination rates right around the Western world. I think that the main takeaway is the economy has largely, and this goes for every country, has largely learned how to deal with COVID. It certainly is still throwing sand in the gears for specific industries like travel and entertainment. I think the main message is as much as we want to be done with COVID, COVID is not done with us, and it will continue to basically weigh on the outlook over the next year, not nearly to the extent that we've seen in the past 18 months, but it will elongate or lengthen or stretch out the recovery. And I really think that is the main message from the COVID front, that unless and until this is completely over, it will continue to act as a bit of a dampener on the broader economy. So what does that mean for global growth? Well, we have chipped away at our global forecast. We have brought it down a little bit since the start of the year. Nothing significant. Around the turn of the year, we were looking at 6% global growth this year. Now we're more at like 5.75%. I would actually assert that even more than the fourth wave and Delta, even weighing more heavily on the global economy has been supply bottlenecks. And especially the chip shortage, but a wide variety of bottlenecks that have weighed on all kinds of different industries, especially the auto industry. That's actually probably had a bigger effect on weighing on global growth than the Delta variant, I believe. And so some of that growth that we thought was going to happen this year will get pushed into next year. We see a more complete travel recovery next year, maybe even by late next year, for instance, and even some filtering over into 2023. Now, to put all these numbers into perspective at the bottom, a normal year, insofar as there is a normal year anymore, for the global economy would be growth of about 3%. So that gives you an idea just the wildness that we've been dealing with recently. That decline of more than 3% last year, that was the deepest downturn we saw in the post-war era. On the flip side, near 6% growth this year is one of the best years we've seen in decades for the global economy. Even next year's growth rate that we see will be well above average. And we've even got 2023 still a little bit above average because the global economy will still be playing catch up from that deep decline that we went through in 2020. We see things normalizing more completely by way out there in 2024. By the way, one specific economy that we have revised down just recently, it's still got a strong growth number, is China. And it's not because of Evergrande. It's more because some of the specific energy challenges that they're facing. You've actually probably seen just in recent days they've had to actually shut factories because of a variety of different energy challenges, specifically a lack of coal that they're dealing with at this point. We've also cut next year's growth rate for China for 0.5%. Of course, the second biggest economy in the world, arguably the biggest by some measures. That is going to affect our overall global economy to some extent. And then you see the variety of other countries. But the main point here is pretty much everybody, to some extent, is bouncing back after a very challenging year in 2020. So that's the very big picture look. Let's bring it down to North America. Much like the global economy, if anything, we've been sort of dialing back our optimism since earlier this year. At one point earlier this year, we thought the U.S. economy could grow as fast as 7% this year. That would have been the best year since 1984. We've had to shave that, again, mostly because of supply challenges, not because of the Delta variant. Mostly because of the struggles in the auto industry and some other electronics industries and manufacturing more generally. We've had to cut that, but we're still looking at close to 6% rebound in the U.S. economy, basically recouping the damage from last year. We've got growth still a little bit above average next year, moderating certainly, but 3.5% is still a pretty strong year. And then we see things getting back to closer to normal out there in 2023. Canada, if you're a keen observer, you'll notice that we've got Canada a little bit below the US in 2019, a deeper drop last year, and not as fast a rebound this year. So what's going on? Why is Canada so much slower than the US? Well, first of all, generally speaking, Canada has slightly slower growth potential than the US. In a normal year, Canada usually grows a little bit slower than the US. So that helps explain 2019 a little bit. In the last 2 years, in 20 and 21, we had tougher restrictions than the US did. We had a better health outcome, but we had much tougher and longer lasting restrictions than the US did. And it did weigh on growth overall. Some people said there wasn't a trade-off between, health and health and the economy. Well, in fact, the US proves the opposite. They basically tolerated a much worse health outcome, but they probably had a better economic outcome at the end of the day. They basically just tried to grind through it. They had a lot more deaths per capita than most other major economies, certainly more than Canada, but they had a less deep downturn and they had a faster rebound as a result of that. You can make your decision on your own whether you think that was the right thing to do, but that was the decision they made. Quite frankly, we do think Canada will eventually catch up. That we think this gap will mostly close over 22 and 2023, but there's a bit of work to do. Like the US, we were more optimistic in the spring on Canada. We had to cut our Canadian forecast. That's partly Delta, partly the supply challenges, but we have really not changed next year's forecast. We're still relatively upbeat. We think some of the growth was simply delayed. Some of the rebound, some of the recovery was simply delayed from this year into next. So we still see a well above average growth rate out in 2022, following a pretty solid year this year, pretty near comeback this year. Now regionally, everybody was walloped last year. No one was spared at all. Everyone went through a very deep downturn. That's true globally. It's true by province, but there were differences. Clearly, Alberta was hit the hardest, mostly because of the double whammy from the collapse in oil prices in the spring of 2020 and because of a tough COVID outcome. Quebec was next because they had a very challenging first round with COVID. Meanwhile, the Maritime provinces actually fared relatively well because they fared pretty well with the virus, and they're not oil producers. So the Maritime provinces were hit relatively lightly. Now, this year has not been, the precise mirror image or opposite of 2020, but it's pretty close. So the economies that were hit the hardest, like Alberta, saw the biggest rebound. The economies that were hit the lightest, like the Maritime, saw the mildest rebound. Not that surprising. And pretty much whoever, has still got ground to make up will more make it up in 2022. Ontario and Quebec had some of the longest lasting restrictions, and that's one of the reasons why we have them coming back a little bit more in 2022. But you'll notice my headline, I say BC tops. Well, if you notice, I actually don't have BC at the top of the list in any single year, but they are close to the top in all 3 years. And if you were to average out this whole time period, you would find that BC will have the strongest growth of the 3 provinces. And that's nothing new, or the 10 provinces. That's nothing new. BC has tended to have the best growth potential over the longer haul, battling with Alberta and then maybe Ontario in third place. And we tend to believe that over the next 5 to 10 years, over the medium term, BC still does have the best growth potential. Whether it's industrial structure, its demographics, its fiscal backdrop, we just happen to think most of the arrows sort of point in BC's favor. As well, BC had a relatively better performance. I wouldn't say it was 100%, but a relatively better performance through most of the pandemic compared to most other major provinces. So it held up better. It got hit a little bit lighter last year, saw a bit of a quicker rebound this year. But overall, I think the main message is when we look through, when the smoke clears and everything's much more certain, we think at the end we'll have found that BC did fare best of all the major provinces, and we think of all 10 provinces through this very unfortunate episode that we've been through. And again, much like Canada as a whole, we see something close to 5% growth this year and around 4.5% growth next year. Now, in terms of the job market, I have to say, I believe the last time I spoke to you was actually in April 2020, pretty much in the heart of the lockdowns. One big surprise since then is how quickly the labor markets came back. This actually is not that far from what we were calling for back in those days. If anything, the jobless rate got even worse during the spring of 2020. But the reversal was almost as quick as I think could have been reasonably hoped for. This is almost as close to a reverse V-shaped recovery that I think we could have reasonably come to have hoped last spring. We've still got work to do, though. In both Canada and the U.S., the unemployment rate is about a 1.5% or maybe a bit more in the U.S.'s case, above where it was before the pandemic began. So we still got work to do, and it's really obvious where that work has got to be done. It's all the high contact sectors. It's the entertainment sector. It's the travel and hospitality sector. That's still not back to normal. And unless and until they get back to normal, the jobless rate is not going to get all the way back down to pre-pandemic levels. That's where the repair is going to be. And it's going to be a process. It's not going to happen overnight. This is going to unfold, we think, over the next 12 to 18 months. But we are hopeful that by the second half of 2022, we'll be close to pre-pandemic levels for the jobless rate. Again, I think a key message, though, is how quickly we've got down to these levels. If you look at the last cycle, it took the U.S. a long time to get down to a 5% unemployment rate. So in many respects, the recovery has actually been a lot quicker in this go around than the great financial crisis of just a little bit more than 10 years ago. And to me, that's actually a good news story, is how quickly the job market, most of the job market in any event, has managed to recover. In BC, it depends on the region. In Kelowna, you can see the unemployment rate is actually almost all the way back down to where it was in pre-pandemic levels. For BC as a whole, it's doing a little bit better than the Canadian national average. Employment, BC is actually the only province in the country where the number of jobs is back to pre-pandemic levels. No other province can say that. At one point, Nova Scotia actually was able to say it, but it's had a lot of shutdowns since then. It's next closest. For the economy as a whole, it's about one. Most other provinces are about 1% shy in terms of the number of jobs getting back to pre-pandemic levels. So BC has definitely seen the best recovery on that front. Now, some of it's also a leader in population growth, so that's part of the story. But overall, it's been a pretty good news story for BC relative to other economies. You can see Vancouver's a bit of an outlier, though. Vancouver's unemployment rate is still almost 3 percentage points above where it was before the pandemic began. So that's against the grain in the broader BC story. Now, one very special feature of this cycle has been how well household balance sheets and finances have fared. Normally, in a downturn, disposable incomes fall, and they fall heavily. People lose their jobs, or they have the number of hours cut back, or their pay gets cut, or the earnings that a small business person can take home get cut. So disposable income falls. Disposable income did not fall this time. In fact, disposable income last year posted one of its strongest gains in the last 40 years. No mystery what happened there. Basically, it was the enormous amount of government support that actually led to a big run up in disposable income. Well, at the same time as that was happening, people were constrained in what they could buy. They could buy goods, but they really couldn't buy services. So we've got, on the one side, disposable income growing faster than normal while consumers are constrained in what they could do. Well, of course, what happened is we just had an explosion in personal savings last spring, which has not gone away. People have actually built on those savings. We now estimate, and around the turn of the year, we got a lot of press on this, that excess savings, savings above and beyond normal had grown to $200 billion. We now think it's about $270 billion. That's about 10% of our economy, actually a bit more than 10% of our economy. That's an enormous amount of potential spending power that could get wheeled out as things slowly work their way back to normal. Now, there's two sides of the coin there. People want to spend, they're really aching to spend, especially in things they haven't been able to spend on, like travel and entertainment and that sort of thing. But on the other side, that's the good news. The bad news is people are not going to be that discerning. I don't think they're going to be that careful in terms of spending. I think that, they're willing to pay higher prices. And so I'll get into this in a minute. It does point to some real inflation pressures in the next year as people are really able and willing to spend. And it's a very similar story in the U.S. Their current savings rate has actually come down a little bit closer to pre-pandemic levels. It's partly because they've gotten much closer to normal than we have in many respects, and that's why the savings rate has come down. But that hasn't dug at all into the excess savings they built up over the past year. They too sell very large cache of excess savings that are just waiting to get wheeled out there. Now, so as I said, this can have an effect on savings because households, as I said, aren't that discerning in terms of, they're willing to pay up. They don't really care if they have to pay 10% more to go, say, to see a movie or a play or something like that. They just want to get out and spend again. And so that's one of the reasons why inflation has perked up. But the other big factor, above and beyond all the traditional and expected factors, we knew that prices were really, really low last spring and that we were going to get a rebound in things like gasoline prices. We knew there was going to be some reopening pressure in things like airfares and hotels as they reopen again. That part was not a surprise, but what was a surprise, besides consumers' willingness to pay up, was the many supply challenges that we've had right around the world. It's especially shown up in things like consumer electronics and autos. We've had an increase in TV prices in the last year. It has been decades since TV prices have gone up in quality adjusted terms. TV and electronic prices have actually been a pretty big weight on measured inflation for decades. Well, they've reversed course because we got this chip shortage. Auto prices, which normally aren't a big deal for the inflationary backdrop, are really stoking inflation, especially in the US at this point. So as a result of just a tremendous run up in vehicle prices, used car prices have gone crazy in the U.S. in the last year. That has blown the doors down on headline inflation. Now, to this point, it's largely a U.S. story. There are some emerging markets too that are seeing a lot of inflation pressure. Canada is next in line. We're about a percentage point behind the U.S. Then you step down to Europe. That's running at about 3% inflation. China's about 1. Japan is doing its usual thing of having no inflation. Nothing ever seems to change in Japan as a small aside. But so why is this? Why is it so concentrated in the US? I mean, for Europe, 3% inflation is actually kind of high. Canada, 4% inflation is kind of high, but we're not in the same league as the US where they've seen inflation of more than 5%. Well, the difference between Canada and the US, I've listed them at the bottom. There's 3 things that are going on why Canada's calmer. One is the currency. Canadian dollar's faded a little bit in recent weeks, but it's still up a lot from its pandemic lows. At one point, it got below 70 cents in the depths of the pandemic. Well, today it's closer to 80. So that comeback in the currency has helped restrain import prices here. Second, cars. Car prices have gone up a lot in Canada, not quite as much as in the US, but here's a wrinkle. So we don't include used car prices in our CPI basket. They do in the US. And used car prices are up 30 to 40% in the US. So just by definition, the absence of used car prices on our inflation numbers have flattered our number. And it's one of the reasons why our reported inflation rate is well below that in the US. The third factor I said is COVID. Basically, we've had a slower reopening than the US, so we haven't had quite the bounce back in things like airfares and hotel charges. So all those factors have helped restrain reported Canadian inflation versus the US. Now, looking ahead, is this going to stick? And this is the $64,000 question in financial markets right now. The Fed and the Bank of Canada have used the word transitory, but I think both their definition of transitory and exactly how high they think inflation is going to get, those have been moving targets in the last 6 months or so. So I think initially when the Fed talked about transitory inflation, they meant, oh, just comparing it to those extremes a year ago, that'll fade very quickly. And then it began to include things like, the reopening trade, things like airfares and hotel rates and that sort of thing. And then it began to include things like used car prices, which they thought, it did surprise them, but they thought would eventually fade. Well, the definition keeps on stretching out, and the height that inflation has gotten to keeps rising. And we have definitely been on one end of the spectrum of this call. We have definitely tended to warn more about inflation pressures being a little bit stickier than others think and going a little bit higher over the near term. And we are still out there. When we compare ourselves to other forecasters, we are at one end of the spectrum. We still believe that, we're still pounding the drum that the risks to inflation are to the upside. Our forecast, yes, it does have inflation coming down over the next year, and that's largely as things like used car prices do presumably begin to normalize. But you will notice that even by the end of 2022, in both Canada and US, we've still got inflation well above where it was before the pandemic. And that is an incredible development. We've just been through the deepest downturn in the post-war era, and we're talking about high side inflation risks. That's, and inflation being the highest here in Canada, that's been 18 years. No one called for that 12 to 18 months ago. No one saw this coming. I mean, I was concerned that inflation might pop a little bit. I didn't think we were getting this high. I didn't think we were going above 5% in the US and that it would stay there for quite some time. So this is quite a remarkable development we got. And I would just stress that again, if anything, I see the potential for a surprise in these numbers over the next year to be to the higher side, not to the lower side. Now, some of the, if we break down, well, what's really been driving the bus in terms of prices in Canada? If you look on the right-hand side, these are the things that have gone up the most in the last year. Airfares, they've still got a way to go, by the way, before they get back to normal. Gasoline price, a lot of that just to bump off the bottom. Hotel and motel rates, again, they've still got a little bit of room to run. Natural gas has really begun to run recently. New homes, that's, I think we're just scratching the surface on that front, and I'll get into that in a minute. I think we've got more to go on that front. And I did talk a lot about auto prices, but there are some other big items here that I think are going to start weighing in a little bit more heavily. I talked about new homes. I think food prices are going to start weighing in a bit more. Meat is there. We've seen pretty broad-based gains in meat prices, but things like vegetables, and a few other food prices are actually still pretty moderate. And I don't think that's going to last. I think we're going to see much more food price inflation in the next year, which will, tend to keep a bit of a flame under overall CPI, even as some of these extremes like airfares and gasoline begin to fade a little bit. There are other big pistons here that we think might begin to kick in. And one certainly is on the housing side. And this is a story in both Canada and the US. It's a little bit louder in Canada, but trust me, the drumbeat is pretty loud in the US in terms of home prices. Now, just from a very big picture, you've heard probably a lot recently about how the housing market has really cooled down in recent months. We've had a number of months where home sales have moderated in seasonally adjusted terms from the prior month. And it is true from those February and March extremes, we have seen the number of home sales come down recently. But let's put this in historical context. Over the last 20 years, we have never seen, even in recent months, we have never seen these kind of numbers before the pandemic. So even with the big supposed slowdown from March and February's frenzy, we're still dealing with very, very strong levels of sales. And meanwhile, supply did have a nice little bump. New listings did go up for a while, but now they're back down to normal. They're not especially strong at this point. So we've still got an incredibly tight market in most provinces at this point. And lo and behold, prices are just still flaring higher across much of the country. They're not rising quite as quickly as they were around the turn of the year. But even since March, even since the March frenzy, if you do the annualized increase in home prices nationally since the March frenzy, they're still up at a 15% annual rate since that peak in March. So they're still seeing strength. And it's very broadly based. It's not, the usual suspects of Toronto and Vancouver. Toronto and Vancouver actually seen slightly below average price increases versus the rest of the country. It's the medium-sized cities. It's the Hamiltons, the Halifaxes, the London, Ontarios, and yes, the Kelownas, that we're really seeing strong price gains at this point, and leading to an average Canadian price increase of more than 20%. Now, we heard in the campaign all kinds of different proposals to try to rein in the housing market, but some of those proposals are actually going to stoke the demand if they actually go through with them. Some of the things aimed at helping first-time buyers. So we'll have to wait to see how many of those measures are actually adopted. But frankly, I was surprised at some of the proposals, especially by the Liberal Party. Things like, banning foreign buyers for a couple of years, or doing away with blind bidding, or bringing in a flipping tax. We'll have to see how many of those actually, become law. But that's actually quite a change, a dramatic change in tone from the Liberals. That was the kind of thing I kind of expected to hear from the opposition parties. I didn't really expect to hear it from the Liberals. And I think the NDP would probably support a lot of those measures. So we'll have to wait to see, as I said, how many of those actually become law. But I'm looking for some pretty dramatic measures on that front. Is it going to do much to bring down prices? I don't think so. I think that, what really will bring this market to heel will be higher interest rates. We are starting, and I'll get into in a minute, we are starting to see bond yields creeping up at this point, but the Bank of Canada, we still see them being very, very patient. So we think that's, unless and until interest rates start to move higher in a meaningful way, we're still relatively constructive on the market. If you look at the dynamics of the market, I mentioned how tight the market is. Yeah, the sales to new listing ratio has come down from the March peak. We're still in seller's market terrain. By any historical measure, we're still very, very strong market at this point. Housing starts, I hear it every single day of the year, how this is all a supply story, and I'm sure many of you would say that as well. But I have to tell you, housing starts are like levels I've never seen before. We got close to these kind of levels back in the 70s when we were having, some of the biggest increases in household formation ever. So housing starts have started to respond. Completions aren't there quite yet. But in the last 12 months, housing starts have averaged 270,000 units. When you go back to pre-pandemic levels, it was closer to 200,000 or maybe a little bit better. So we've had quite a step up in new building. As I said, it'll take some time before they're actually completed because a lot of these are multis. So it's gonna take some time, but the supply is on its way. It is in the pipeline to some extent. And I would assert at 270,000 units is actually well above demographic demand for new units. So the supply is starting to respond, and ultimately this too will help stabilize the market to some extent, especially if we stay anything close to these kind of levels in the years ahead. But like I said, I think ultimately it'll take higher interest rates. In terms of the short-term interest rates, we've been sticking with the same call for quite some time. We don't see the Bank of Canada raising interest rates until about a year from now. We've got the first rate hike by the Bank of Canada in October 2022. We think the Federal Reserve will not be far behind. It's a close call, but at this point, we've got the Federal Reserve hiking at their first meeting in 2023, so still well more than a year from now. The latest Fed meeting, where they always do the infamous dot plot, or the survey of forecasts of Fed members, shows that they're very evenly split in terms of that first rate hike between late 2022 and early 2023. Unfortunately, those dots don't reveal who's voting what, and I happen to believe that the chairman, Mr. Powell, is actually a little bit more dovish and is looking to not raise rates until 2023. If we're wrong on this forecast, usually I tell you or tell my audiences that it'll be later rather than sooner in terms of when those rates will be hiked. That's not the case this time. I think if we're going to be wrong, the interest rate increase could be pulled a little bit forward. But I would just stress that the central banks will be very patient on this front. They want to wait until the job market is really closer to full health before they start raising their interest rates. Now, those are just the very short-term interest rates. That's what the central banks can directly control. They can't directly control longer-term interest rates. And we've had some really wild movements in long-term interest rates this year. When we first started this year, we just saw long-term rates bolt out of the gates. The view on Wall Street became incredibly upbeat on the US economy. They built in the whole reflation trade. They had the economy roaring back, as we did as well, and they priced that into bonds almost right out from the get-go. And then we did a slow drift down through the spring and summer. As Delta dawned on the outlook, to refer back to my bad pun at the start, but also as supply challenges really began to crimp down on growth, and the reality, became a little bit more apparent that this cycle was going to take longer to get back to normal. But in recent days, we've started to see those yields tick back up again, partly because the Fed has said they're going to start tapering quantitative easing, partly because the market is becoming a bit more concerned about the inflation backdrop, with oil prices heading up to $75, with gas prices getting above $5, natural gas prices getting above $5. The market's getting a little bit more spooked on the inflation front, and that's driven these yields back up. Not quite as high as they got in the spring, but getting there. In our underlying view, it's not going to be as smooth as this forecast suggests, but our underlying view is that these yields will continue to grind higher. We've seen the 5-year rate get above 1% in both Canada and U.S. in recent days. That's the highest since the pandemic began. That's going to start pushing up longer-term mortgage rates, we think, in the days and weeks ahead. It's definitely the single biggest driver of 5-year rates is the 5-year bond yield. And so we do think there will be some steady upward pressure on fixed rates in the weeks ahead. As I said, nothing dramatic, but we do think that the corner has been turned, and that rates will begin to grind higher, even without the helping hand of increases in short-term interest rates by the central banks. Just a few quick points, and I mentioned oil prices coming back. When we look at the commodity price basket in Canada, you can break down it between energy prices and everything else. And what we saw earlier this year is the X-energy basket hit an all-time high back in the spring. This was largely a lumber story, but it wasn't totally lumber. We saw all kinds of different commodities, things like copper and base metals and gold and agriculture products really taking off earlier this year. They moderated somewhat in general, but they're still high. Commodity prices are still very favorable in general. And now the big kahuna is starting to kick in. Energy, oil and gas. Oil is the single most valuable commodity that Canada produces. It accounts for almost half the value of all commodities produced. And it, of course, is starting to move. Now, our assumption has been that WTI will average $65 a barrel this year and $70 next year. Well, as we speak, we're at about $75. So the risk there is pretty clearly tilted to the high side of that forecast. And as a result, it does tilt the Alberta forecast for next year a little bit to the high side. It also tilts the inflation forecast a little bit higher than what we have in the official call. It also does, I think, help support the outlook for the Canadian dollar. Now, trust me, I am not a big bull on the Canadian dollar. I believe that we have all kinds of competitiveness challenges in this economy. I believe that the long run fair value for the Canadian dollar is somewhere between 75 and 80 cents. Now, you'd probably say, well, that's a range that you can drive a Mack truck through. But, when you think back in the last 20 years, we've been everywhere from as low as 62 cents to as high as $1.07. So I think 75 to 80 cents is a pretty narrow range considering the history we've had in the last 20 odd years for the Canadian dollar. I think 75 to 80 is pretty close. So we're at the upper end of what I would consider to be fair value as we speak. I actually happen to believe in the next 18 months, the Canadian dollar might get a little bit above that fair value range, partly because energy prices are very supportive. Commodity prices generally are pretty supportive. Also, in a world where we are seeing a return to something close to normal, we are seeing a relatively strong global economy. That's usually supportive for the Canadian dollar. And lastly, we do see, as I said, we do see the Bank of Canada raising interest rates a little bit ahead of the Fed. And so for all those reasons, we have the Canadian dollars firming slightly over the next 12 to 18 months. Again, that's a short to medium term forecast. Longer term, I would have the currency dipping back down to that kind of range if I were to trace it out further. But at least over the next 12 months or so, we are relatively constructive on the Canadian dollar. So bringing all these threads together, big picture is, again, the pandemic is still with us as much as we wish it wasn't, and it will continue to frustrate a very quick return to normal. But essentially, we do believe that for the large part, whether you talk about the job market or things like interest rates, we will be getting closer to something like normal by the second half of 2022. And most other sectors outside of travel and hospitality, they have fully recovered. They are back to normal. Some have actually gone above and beyond where they were before the pandemic. They've actually offset or partially offset some of the weakness that we've had in the hospitality sector. So the concern now is actually tilted the other way. The concern is that things have gotten a little bit too hot, and that we might be dealing with a really serious inflation episode. I still believe that the central banks will actually be very patient, and they'll keep looking through this, waiting until the job market gets back to normal, and then that's when they're going to begin to move. Now, there is a risk. There is a risk in that environment that when they begin to move late next year and into 2023, they've got to step on the brake a little bit harder than they hope to. That would be one of the bigger risks to my forecast over the medium term. That, when the pandemic is hopefully in the rearview mirror by then, that the central banks have to squeeze a little bit tighter and things cool a little bit more rapidly when we get out into 2023. I think that might be one of the bigger risks that we're dealing with. I've listed all kinds of other things that they don't necessarily keep me awake at night, but they do concern me. That whether it's on the geopolitical front or some of the cyber issues we're dealing with. If I had to pick one from that long list, I am concerned about the potential for a ramping up of hostility between the two biggest economies in the world. One thing that did not change as a result of Biden becoming president is, the tone in China-U.S. relations. Maybe the words changed a little bit, the lyrics might have changed a bit, but the tune did not change. That's one thing that there actually is a lot of bipartisan agreement in Washington on, is to be tough, relatively tough on China. And it is an area that I'm watching very carefully. And if I had to, circle one real geopolitical risk, it is for increasing friction between the U.S. and China. And on that happy note, I'll actually ask Luke to rejoin us at this point, where I think looks like I've left a little time for Q&A. So I'll hand it back to you, Luke, and welcome back to the conversation. Thank you. You're actually on mute.
Thank you. Thanks, Doug. Appreciate it. Great to come back on that happy last note. So appreciate that. Thank you. So I'll just remind our participants here on today's webinar that we'll be facilitating a Q&A. And if you do have questions that you want to add, there is a Q&A function at the bottom of the Zoom screen. And I've got a few for myself here as well. And maybe just a broad question to start, Doug. Could you provide some insight more into global investment trends and how you see Canada faring competitively in the global landscape?
So, and of course, one of the big themes in recent years has been on the ESG side of things. And I think often the go-to assumption is, well, we're in big trouble on that front because we're a big oil exporter. Among the OECD nations, one of the largest as a share of our economy. The oil sands always haven't had the best reputation, suffice it to say, internationally. But I'm not sure that's the right answer. When you look at the S&G part of it, I would say Canada stacks up as well as anybody in the world, or close to. We're definitely at, we compare very well on that front. And I would assert even on the environmental side, I think some of the oil companies have been making great strides on that front, and actually, are coming in a somewhat better light on that front. In general, let's, we just heard the news in the last 24 hours that the Case de Depot, one of the largest pension funds in Canada, is going to divest from oil and gas investments. That's the kind of thing I think we're going to hear a lot more internationally. So that is a challenge for one sector of Canada. But I would say the rest of the country actually, the rest of the economy actually does stack up very well. I think we compare relatively favorably. And then there's all our long-standing, positives as well, that I think are still attracting a lot of investment. We haven't fared extremely well on foreign direct investment. There's no question about it. We've actually seen net outflows, but that's as much a story about our own companies investing very heavily abroad, as much as the amount of money coming into the country. The amount of money coming in the country by foreign companies is actually relatively stable over time. We haven't seen it really dry up. It just hasn't really thrived, and a lot of that does go to the amount of money going to the energy sector has really waned. Other sectors have fared relatively well. One concern I do have, though, longer term, is on the competitiveness front. I mentioned that in my view on the Canadian dollar. I think we have to be very careful, in terms of tax policy in particular, in terms of regulation, is not to get out of line too far with the U.S. and our major competitors. We heard all kinds of rhetoric during the election campaign, about making the big companies pay and that sort of thing. I think we have to be very careful. We already have when you combine the provinces with the federal government, we have a higher corporate tax rate than the U.S. does. That was not normal for decades. We had a lower tax rate, before the big reform in the U.S. in 2017. That used to be a big calling card. Corporate taxes aren't going to be the single driver of investment decisions, but they do play a role. We need every helping hand we can get. So we have to be very careful on that front, not to tie our hands behind our back. Now, it is possible. It's entirely possible that we could see corporate rates going higher in the U.S. and elsewhere. The Democrats actually have a proposal on the table to raise corporate taxes to pay for, this grand $3.5 trillion spending proposal they have over the next decade. If that's the case, yes, that'll probably give cover for Ottawa to bump up corporate taxes a little bit. But again, let's face it, on the personal tax side, we're not competitive with the U.S. We are not, and we are, especially at the sort of lower high income, I like to say, sort of the starter professionals. Our top marginal tax rate, which is well above that in the U.S., kicks in way earlier. Basically a person making, I realize it's a good pay, but a person making 230,000 Canadian are paying 53.53%, but who's counting, marginal tax rate in Ontario. That's well above what it would be in the U.S., and that kicks in way earlier than it would be in almost any jurisdiction in the U.S. We're not competitive in that space, for basically mid-level professionals. And if we want to attract tech talent here, that's tough with it. So I think we have to be careful before we quote tax the near rich, as one party wants to do. We really have to be careful on that front.
Great. Well, thank you. Drill down a little bit more closer to home. You had talked a little bit about what gives BC in particular maybe a better long-term outlook over maybe a 5 to 10 year trajectory, say compared to Ontario, where you are. Can you expand on some of the factors of what gives BC that sort of long-term platform?
So there are a few things. First of all, it's demographics are relatively positive. I mean, that in a way, that's almost what sets the large provinces apart from the 6 smaller provinces. There is a tendency for migration, whether it's international migration or domestic migration, to go to the 4 big provinces. Some have suggested Alberta might be a bit more challenged on that front. I'm not fully convinced of that. Quebec might face a little bit more of a challenge there, but Ontario and BC definitely tend to see a bit more immigration and internal migration than other provinces. But BC sees a lot more internal migration than most other provinces. So the demographics are a bit more positive for BC. So that's strike one, or one positive, I should say. Second positive, I touched on it very briefly. The industrial structure, I think, does tend to favor BC. I mean, historically, it's had a big weight in forestry and mining, which you wouldn't think would be big positives. Maybe not. But on the service side, there are a lot of positives for BC. Whether it's burgeoning tech sector, or its tourism sector, which hasn't fared well in the pandemic, but longer term, I do think is a big feather in BC's cap, and other services as well. Even the TV industry, for instance, that has tended to be a big positive for the economy. But that's just one small example. I think the industrial structure just tends to favor BC a little bit more. The third factor, BC's fiscal finances. This current government has been pretty generous, but they had a good starting hand. They had a good hand that they were dealt with. And when you look at BC's deficit to GDP or debt to GDP ratios, it stacks up very well versus, say, Central and Eastern Canada. It's comparable to Alberta, very, very different story, of course. Alberta has extremes. Alberta might have slightly lower debt to GDP than BC, depending on which day we're measuring it on. But longer term, I think BC's got very strong provincial finances, and effectively what that means is it gives the government a little bit more leeway. It also means they're not going to have to see the kind of restraint after we get through this that a place like Ontario, Quebec, or the Maritimes are going to have to deal with. So they're not looking at the same dead weight drag that, say, a place like Ontario will be looking at. By some measures, Ontario's got the worst finances in the country. We've probably got better demographics than much of Eastern Canada, but Ontario's got its own challenges on the fiscal front. Has got a bit of a rust belt, frankly, in parts of the economy. So just for all those factors, I do, and it's not just because I'm talking to a BC audience. We have long believed that BC has the best growth dynamics over the medium term.
Yeah, I mean, you definitely have a favorable audience for that, but it's good to get some of that insight. You touched on immigration a little bit, and a question with regards to, obviously, the federal government has arguably some large demographic or immigration targets, and that was restated prior to the latest election. Could you provide some thoughts about how you think this might impact the housing market over the next year or two?
And it's very interesting. This is an obvious area where some of the goals clearly conflict, because I'm a big believer that there is just no debate that one of the major reasons why we have such strong home prices, and if you look over the last 20 years, Canada has had one of the biggest increases in real home prices in the Western world. New Zealand's in our league, but that's about it in terms of who's seen the strongest home price increases. And I can draw a direct line. If you do a scatter shot of population growth versus real home price increases in the last 20 years, everybody in the upper right of that is, Canada, New Zealand, Australia have all seen the strongest population growth and the strongest home prices. That's not a coincidence. In the weakest population growth, the weakest home prices, places like Italy, Japan, there is a straight line between population growth and the pressure on home prices. That is not debatable. I don't believe. So what comes with strong immigration flows is pressure on home prices. I happen to believe that the way this government will, which goal will they view as more important? I think they'll view immigration as being more important than controlling home prices. They've pretty much said that they want to make up for what's been lost over the last 18 months. In the next few years. We by the way, we just had the latest quarterly population estimate today, as of July the 1st, and population was up 0.5% in the last 4 quarters. That's actually the slowest population growth we've seen since World War I. Now you might say, Doug, doesn't that just conflict with what you just said? We just had home prices, go up 20%. And we've had, next to no population growth. Well, I will dare say that we've had extreme circumstances in a lot of other aspects of the economy in the last 12 months, the collapse in interest rates and the fact that, we've all been stuck at home, or most of us have, and, looking at our 4 walls and wanting to move or upgrade our that's a once in a lifetime event that we've been dealing with on that front. So, there's not really that much surprise that we've had a boom in home prices, even with weak population growth. What I'm concerned with is when the population growth does return, what's going to happen to home prices then? Some of those factors will fade, and interest rates, I think, will become less friendly in the next 18 months. But I think, I think this is going to keep the flame under home prices. And so we fundamentally believe we are constructive on home prices. I take the Liberal government at their word in terms of their immigration targets. I think they are completely serious, and I think there's a lot of demand out there for people to still move here. So I take them very seriously, and I think we will see very strong immigration flows as the pandemic fades.
Yeah, and I don't disagree. A number of folks that I speak with in the industry have that same comment around where housing prices have gone, where the market has gone over the past while, despite the fact that for global factors, immigration targets, couldn't have been met. So that will be interesting to watch. You touched a little bit on new housing measures in the Liberal platform and some that might sort of counterintuitively fuel prices even further. Would you mind expanding on that just a little bit?
Yeah, and it's a lot of the micro issues that they were talking about, things like a savings account for first-time buyers and, maybe relaxing some of the rules around CMHCs. We can quibble about whether any of these are helpful or stepping in the right direction, but if we stand back and take a big macro look at it, I think that's absolutely the wrong answer at this point. We have got okay, it's not a 5 alarm fire anymore in the housing market, but we still got a 4 alarm fire going on. You do not want to do anything at this point, at least, that stokes demand. We've still got, if you recall back to my chart, and I see I'm still sharing my screen. If you think back to my chart on the supply, I mean, look at that supply demand imbalance that we've still got. And whether you look at the months of inventory or the sales to new listings, this is still an incredibly tight market. And I think the wrong answer at this point is to do anything to stoke or support demand. I know what they're doing. They're trying to separate the first-time buyer from, say, the investor or the foreign buyer or the non-resident buyer. I know they're trying to do that, but it's debatable whether they can do it that finely. And frankly, I think they should hold off on anything that supports demand until interest rates begin to start to normalize a little bit. Then they can start thinking about some of those micro measures later on. It's amazing. Every time the economists get together with the finance department, we always tell them the same thing, like, don't do it. This is the wrong answer at this point in the cycle. Save that for when the market's weak. Don't throw gasoline on the fire at this point. And they think us very much, and then go ahead and do it. Because it's a political winner. So,
right. Maybe I'll last question. We've got a few other questions, but we're running out of time. You mentioned near the end there where the central bank might have its hand forced with regards to inflation. At what point would inflation become that much of an issue that it would force the central bank's hand ahead of like what your forecast was looking at?
So officially, the Bank of Canada still on its books has a 2% inflation target, and they generally tolerate things between 1% to 3%. You're saying, well, I believe that's a 4.1% inflation rate they have right now. They would argue that there are clearly temporary factors going on here that will fade, and if you look at their beloved core measures, if you take an average of their core measures, it's about 2.5. So it's just barely still within their zone of tolerance. By the way, the Bank of Canada every 5 years, in agreement with the government, reviews that inflation target and their mandate on that front. It just so happens that they were knee deep in doing that review right now. And the next month or two, they're going to have to bring forward that latest 5-year review. Of course, they had to wait until after the election. I don't think there's going to be any huge changes there, but what they might do is sort of tilt it more to sort of an average inflation rate of 2% over the cycle, which means, because it was below 2% for a long period of time, they'd be a little bit more tolerant for some time yet. Same story for the Fed. They actually officially now target over the cycle a 2% inflation rate. It was below their beloved metric of inflation was below 2% for quite a while. So they're very tolerant of what we're seeing now. But you can see some Fed officials are getting antsy already. Some are already talking about we should be tapering quantitative easing now. We should be raising rates next year. There are a lot of Fed regional presidents who are actually antsy now. Powell's still talking very brave game at this point, but I think the Fed and the Bank of Canada are nervous now. If they don't start to see inflation fading in the next couple months, we could start hearing the message changing. I think the real test will come in the spring of next year. If we don't see inflation fading by then, you could hear a pretty dramatic change in message by the Fed and the Bank of Canada by late spring, summer of next year, where like I said, the danger is, to our forecast of a rate hike and first rate hike in October 2022, that might get pulled in mid 2022 by both the Fed and the Bank of Canada if we don't see inflation fading by next spring.
Well, there's no shortage of different trends to watch, that's for sure. And I think it's difficult to be making forecasts at the best of time, and then in particular in volatile times like this. So certainly appreciate you putting the data together and providing some of your insights as always. So thank you on behalf of UDI for taking the time today.
My pleasure, Luke. Thanks for having me.
So with that, I will kind of end the webinar. I want to remind the listeners here that we have our next webinar that's going to take place on October 21st. So I want everyone to be able to stay tuned for that. If you have any ideas for future speakers or different questions about UDI, we've got our contact information here as well as our social media platforms that you can engage in. I'll also remind everybody that a recording of this webinar and those slides will be available on the UDI website in short order. So with that, again, thank you very much, Doug, and I'll bring everything to a close and enjoy the rest of your day, everyone. Thanks so much.
Bye, everyone.